One of the things about Lehman was that made it systemic was that it would, as Steve noted, affect all of us. So back then, it was a crisis of the banking sector, and if the bank, and we're all connected to the banking sector. I mean, if you have money, you put it in a bank, right? So if there are problems with the banking sector, then and you have a lot of, let's say, deposits at a bank, so you're lending the bank a lot of money above and beyond federal insurance, then obviously that puts you at risk, and nobody wants to see all their money go poof. And at the same way, many people depend upon banks for credit. Let's say the bank makes a loan and it starts to lose money in that loan. What happens is that those losses, the capital buffers those losses. So the amount of capital that the bank has is basically the level of losses it can absorb. And if it doesn't have a lot of capital, like it didn't back in during the great financial crisis, then the bank goes bust and then it goes bankrupt like Lehman. And as we all know, that's not good. So like Stephen mentioned now is that by increasing the amount of capital in the bank, the amount of loss absorbing capacity the banking sector has, that makes it less likely that a bank would go bust. And so that makes the financial system safer. So the system wants you to hold more capital against assets that are riskier. That makes sense, right? If you have an asset that is more likely to default, like a subprime mortgage, you want to hold more capital against it because it's possible you would have more losses, and more capital protects the other, I guess, depositors from a bankrupt bank. And one of the ways you could game that would be actually just through ratings. So back then, pre-GFC, ratings were an unregulated industry. So you could just, call up a few ratings agencies and see if they would stamp your asset with a AAA or something like that. Then you would not have to hold as much capital against it because it would be a safe asset. I used to actually work for a ratings agency, and what I would see happen sometimes is that the bankers would call us for a deal and basically try to figure out how high a rating that we could give them. And they'd call, and then if we would say A and they wanted something like A+, then they would kind of disappear and we never hear from them again. And maybe a few weeks later, we would hear that another rating agency was able to offer them what they wanted, and so they went with them. So this prospect of actually shopping around ratings was a way to game the regulatory framework. But that's a lot has been done to improve that so far. So that's all more regulated, and there are stress tests now. So the Fed actually makes banks test their assets according to specified parameters. Like the banks run their own, but the Fed also runs their own model as well. So that's an improvement. And like Stephen said, the off-balance sheet stuff was a really big innovation. So pre-GFC, you could have a lot of what would count towards regulations was not the same as the actual risk that a bank held, because a lot of it was in terms of off-balancing derivatives that really wouldn't show up on a standard regulatory balance sheet. But since then, they've added supplementary leverage ratios, which Stephen mentioned, that forces banks to include that potential future exposure into their leverage ratio. So again, it's making the system a lot safer. It was when the ratings agencies were very boring and highly regulated. They would tell me back then, pre-GFC, man, times are good. We had all these, it was like working at a tech company. You would have these huge pantries full of all sorts of snacks. You can eat as much as you want. And that was all gone when I was there. Because back in the pre-GFC world, so it was like Fannie Mae selling insurance, right? You would rate AAA something, collect, tremendous like ratings fees. So ratings agencies, if you look at Moody's, for example, which is publicly traded, they print money because it costs a lot of money to get it rated. And then thereafterwards, there's an ongoing revenue stream where you pay, a lot of money to have it monitored every year. So to maintain their rating, which really takes like 10 minutes for the ratings agency. So they have this tremendous income stream. And back then, because first of all, there's a lot of issuance and securitization. So every issuance requires a rating. And also because, house prices only went up. So you could say whatever and no one ever defaulted and no one really cared. And so they really just printed money back then. And they still do very well. I think one reason why we see fewer financial crises, and in my view, it's less likely to see financial crises in the private sector going forward, is, as Stephen mentioned, that we've really learned from the Lehman episode. So heading into Lehman, I remember back then the commentary was like, we have to bleed moral hazard out of the financial system. That is to say that, if we help these guys here and when they're in trouble, then that means that that kind of takes away their incentive to behave properly. And so that encourages more bad behavior that creates moral hazard. So we got to let them fail. And after they did that, they realized, actually, that's not a good idea. And so going forward, they didn't just make the financial system safer through the regulations. I think they're less inclined to take that risk of letting the system, I guess, have distress, because they realize the consequences were very bad. So the current crop of regulators, a lot of them cut their teeth in the time of Lehman. So they're very scared of this. And so their instinct, I think, is to intervene and step into the market to prevent any type of crises. So in 2020, when we had, I guess, some disruption in the financial sector, they kind of really showed that. They opened up the emergency lending facilities for a wide range of financial sector actors, and including actors that they have not lent to before in the past. So I think that impulse, that, I guess, trauma from Lehman makes it unlikely for Lehman to occur, simply because everyone is scared of it and they have the tools to stop that. My perception, being on the open markets desk back then, was that there was tremendous amounts of panic and the Fed was really just willing to do anything to make it go away. And I mean, remember our chat with Nick Timareos on his book, and one of the things his book reviewed was the Fed was actually inching close, potentially even buying mutual fund shares. So they were willing to provide liquidity to a wide range of non-bank financial institutions. And what actually was rolled out was what was actually contemplated was more than what was actually rolled out, because conditions improved. So that kind of, in my view, kind of completely forgets the moral hazard concerns of acting in this way, because I think moral hazard is a legitimate concern, because if everyone perceives that the Fed is going to step in and support, say, the private credit market, whenever there's a significant distress, then your incentive obviously is to just lever up and not worry about this. So what was something that the private investors once had to worry about, now, because of the Fed's actions, is something that they've outsourced to the Fed to worry about. So I think socializing all this risk has some consequences that probably are not apparent immediately, but may become more apparent later on as people adapt their behavior to kind of not price in certain risks. Now, about whether or not rate cuts or I guess the balance sheet, how they operate, I think they operate in different channels. And back then, what you really wanted was a more quantity-based approach, because people needed actual cash. It wasn't that they needed cash at a certain interest rate; they just needed cash, and the Fed was able to provide that by simply stepping into the market, printing money, and buying their assets. So really playing a dealer of last resort, or in a sense, a lender of last resort role by being willing to monetize a lot of the assets that the private sector wanted to sell. So I think it was the right choice.